Good afternoon and welcome. My name is Karen Doyle and I'm part of the CTAM Europe team, and I would like to welcome you to today's joint webinar with Ampere Analysis. This is a new type of webinar for us and hopefully the first of many, where some of our industry leaders, analysts, journalists and industry leaders will share their thoughts and views of large events that have recently taken place. Today we are pleased to welcome Guy Bisson, Ampere's Research Director. Guy will give his thoughts on the happenings at MIP this month, and there's a chance for questions at the end of the 20 minutes webinar. Before I hand you over to Guy, I would like to play a very short video about CTAM Europe's annual Executive Management Programme, which is happening in June next year. The programme has been running for 6 years and we've educated over 170 of our industry's leaders. The programme is aimed at senior executives from the cable, connectivity, digital, telecommunications and content industries, along with some key suppliers. Guy, please play the short video.
CTAM Europe Executive Management Programme at INSEAD. An intensive, comprehensive learning and development experience developed for the connectivity and entertainment industry. A program to help industry leaders stay one step ahead of the changes in our industry. At the inception of the 5-day program, we chose to partner with INSEAD, the business school for the world, whose global MBA program has been ranked as the #1 program in the world for 2 consecutive years. Senior executives at the top of the organizations have the time to reflect and think about the seeds and trends of change during the 5-day program. The program has helped over 150 senior industry leaders become better leaders throughout the past years. The classes are generally around 20 to 30 participants, and therefore chances for discussions throughout the week are extensive. In addition, there are some fabulous organized networking and social events. New contacts are made and nourished throughout the week and beyond. We hope to welcome you or your organization's leaders onto our next program.
Thanks, Guy. If any of you wish to have more information or would like to register, please email info@ctameurope.com. Registration is now open for next year's class. Also, a quick reminder that as a member of CTAM Europe, you are entitled to a €300 discount at next month's Cable Congress in Berlin. Now, before I pass the baton to Guy, I'd like to mention that all participants will be muted throughout. If you have any questions, you can use the button on your screen to submit them, and Guy will answer these at the end of the session. So, sit back and enjoy, and I'll now hand you over to Guy.
Thank you, Karen. Good afternoon, everyone. My name is Guy Bisson. I'm Research Director and co-founder of Ampere Analysis. For those of you who don't know us, we are a London-based firm of analysts who focus on the TV and entertainment industry globally and supply data and hopefully insight on the changes that are going on in our business. What I'm going to do for you today in a short presentation is really discuss and run through what my key takeaways of the trends that emerged at this month's MIPCOM content market in Cannes, and open for discussion at the end in case you have any views you want to share, any points of clarification or anything you'd like to add generally to the discussion. So MIPCOM, of course, is one of 2 markets in Cannes each year. Generally, it's become the larger of the 2. For those of you who are familiar, MIP TV in April, MIPCOM in October, and now that MIPCOM is larger, there's a rethink around the MIP TV market in April, which will broadly focus on encouraging more small producers and more early project development for content producers and financiers. MIPCOM is more focused on distribution, and as such, it was a reflection of the many, many changes that are going on in that market. And I'm going to run through some of those now. So first impression, I guess I'm calling the quiet before the storm. I think unless you've been living under a rock for the past 5 years, everyone in the industry is aware of the imminent change that is happening in television distribution. That change, of course, is the studios, the major studios, planning to go direct. We are on the verge of 4 major direct-to-consumer launches, 2 in November and 2 for April 2020. So first to market will be Disney and Apple. Disney launching in the US, Canada and the Netherlands, shortly followed by Australia and New Zealand. Their plan, of course, is to create a package or bundle of streaming services that will feature their sports line in ESPN and Hulu as an ad-supported TV add-on. Now, interestingly, that one launch encompasses many, many trends that we're going to touch on. First of all, of course, is the studios going direct. Second is the licensing challenge that imposes for other TV channels, other streaming services, but also distributors. And third is the fact that it's a hybrid model mixing advertising with subscription video on demand, all key trends within the industry. HBO Max from Warner Media we heard a little more about yesterday with a launch price of $14.99. That is the same as their current streaming service, HBO Now. And exclusive content, I found it slightly amusing that one of the key highlights they chose to point out was exclusive South Park content, but there you go. Peacock from NBC Universal is earmarked for April next year, and again will be a hybrid model. And a slight outlier in that it's not coming at the market from a studio and content perspective, but from a device platform perspective is, of course, Apple and Apple TV+, whose strategy is focused on super aggregation of multiple streaming services, as well as traditional pay TV package subscription offers. So what were the impact, or what was the impact of this imminent launch of these services? Well, as I said, there was a feeling at the market that a lot of change was on the way, but we haven't quite seen it come to fruition yet, not in its entirety anyway. However, we did hear from Warner Media's chairman and head of DirecttoConsumer, who told the audience that Warner was going to go for an aggressive rollout, as he described it, of HBO Max across the international stage. And an interesting point that I took from this, we tend to think, when we think about direct-to-consumer and Disney and Warner and what all the studios are up to, about own content, about their catalog, about their archive, about their own studio output, and about their originals. But he was talking about an additional acquisition spree that his executives are going on to feed that platform with additional third-party content. So I thought that was a very interesting point. However, as of yesterday, I could add a second slide to this. So October the 15th, at the MIPCOM market, we heard about Warner's plans for a very aggressive global rollout of HBO Max. Yesterday evening, we heard that Warner had renewed its traditional pay TV output deal with Sky across 5 or 6 European markets. So a bit of a mixed message there in terms of quite how aggressive that HBO Max rollout is actually going to be. Another impact of direct and the changes that are in the industry is internal uncertainty. So talking to the international sales divisions at some of the larger organizations, internal licensing challenges was one of the discussion points. What does that mean? Well, basically the sales teams themselves are not sure what they're going to have to sell next year, the year after, even perhaps in the next 6 months, because their own parent company's plans are often not fully formed, or at least not fully specified in terms of geographic rollouts, the basis on which the rights and the content is sold. So while that is all in development and all up in the air, the international sales teams are saying what's actually going to be left for me to sell in the coming 2 to 3 years. Knock-on effect of that, of course, is that the contracts themselves are changing. So whereas a 5-year contract period might have been the norm for deals a few years back, a lot of people are now looking at 1, 2, sometimes 3, but often much shorter contracts for any content that they are selling, fully aware that their parent company may wish to pull the content back for an own direct service launch imminently. And that is not just affecting the studios, it's affecting any large content owner, so Discovery, for example, echoing these sentiments as well. Another knock-on effect of the imminent direct push is that the market was a busy one for independent distributors. So of course, if the feeling is and the fear is that the majors will be pulling back content and keeping it for their own services, if you have access to content that is not part of that catalogue, then you're in the market and people are chasing you to start to do business or form new business relationships. I guess a key reflection of this is I was out to dinner on actually the first night of the market with about 25 independent distributors, and several of them were saying that their diaries were full until 7 o'clock on Thursday evening. Now, if you've been to the market before, you'll know that normally it's getting pretty quiet by Wednesday evening. So to be fully booked till late on Thursday is quite unusual, and I think a reflection of this trend. Next key point is internal reorganization. So we've seen a number of groups reorganizing on the back of several related trends. Of course, we've had mega mergers of the studios, the likes of Disney, Fox, of course, NBC, Comcast, Sky, very large groups merging, and the norm is to reorg, realign, rationalize divisions, etc. But a subsidiary trend of this is that other large players who are perhaps not in that top tier category have been expanding their business into adjacent areas. And I would say key examples of this would be WME Endeavour, Beta Film, Fremantle and Banijay, BBC Studios, ITV Studios, effectively realigning their businesses, expanding horizontally to act and become more like studios. And that, of course, is also filling the gap that is being left partially by the studio majors. Phase 2 then of that is to internally reorganize to position for this future of direct and the opportunity that is presenting for demand for original production, demand to license out production, demand for licensed catalogue content. ITV Studios, for example, gave a lot more detail on their recent reorganization into 3 divisions. Global Entertainment, which is charged with creating and developing formats. Creative Networks, which is the umbrella for the unscripted divisions within ITV Studios, which now totals 36 of the 57 independent labels that organization encompasses. And Global Distribution, handling international sales. Next trend then, again related and calling "When I Grow Up, I Want to Be a Studio," and this is the trend of pretty much everyone either becoming, re-engineering as, or launching a studio type business. We heard from a number of players who talked about creating new studios. So while BBC Studios were out in force with a very fancy new stand, ITV Studios also, we heard from Germany's Beta Film, who launched a new Nordic and Scandinavian studio during the market on the back of a couple of additional production acquisitions. And we heard from Nordic Entertainment Group, that's the umbrella for Viaplay and some of the Scandinavian TV assets of what was Modern Times Group, also announced a development and expansion of their Nent Studios UK. Key to that was that they are putting a large amount of original production through that new UK studio operation, and also that they're taking over projects from another initiative of which they were founding members some years back, that is the Atrium SVOD Buyers Club. Now that was a grouping of regional SVOD players who had pooled resources in order to take on Netflix in being able to greenlight large budget English language drama productions. It seems the complexities of that setup have led it to flounder slightly, and that going forward they'll be seeking to engage in projects with only one single partner, and a lot of that will be going through Nent Studios UK. They also talked about doubling down on their original output. So as a regional SVOD player, Viaplay active across Scandinavia, but even at their scale, they're talking about 40 high-end original productions a year. So you can see the sort of volume that we're beginning to talk about in terms of high-end original production, even from smaller regional players. And that's becoming very clear when we look at the commissioning trends of those groups benchmarked against the majors. So we can see, while Netflix is the largest commissioner of content, this is all future production. So this is our chart showing greenlit or in development, but not yet aired production. While Netflix is way out in front, you can see that the groups that have recently adopted studio strategies, like the BBC, like ITV, like Viaplay, that's Nordic Entertainment, like Atlas Media, also recently launched Atlas Media Studios, are showing up in the top 15 or 20 commissioners globally. And then alongside those, we have the major US networks and the larger regional SVOD players. So a significantly changing landscape in terms of production and commissioning. And what does that mean? It means that the content bubble that people have talked about for 5, maybe more years is not going to burst anytime soon, and thus is not a bubble but a boom. And just to put that in perspective, we have seen a 30% increase in global spend on non-sport content in the last 5 years. That is almost 3 times the growth rate of the previous 5-year period. And if that is not a boom, then I don't know what is. Next trend, again, knock on, all of these are related on a continuum, is consolidation, phase 2 and phase 3. So if phase 1 was the mega mergers, the Foxes and the Disneys, phase 2 was the internal reorgs and the horizontal expansion that I was just talking about. My view is that phase 3 will be consolidation in the supply chain. And what does that mean? It means independent production and independent distribution. And perhaps Banijay Endemol, which was announced just the week after MIPCOM this year, is the first in many on that phase 3 trend. AVOD was a super hot topic at MIPCOM this year. So to date, the streaming market globally, I think you'd agree, has been driven by the subscription model. We are on the verge of a very big shift, not just in hybrid, because Hulu has shown in the US how successful a hybrid model can be. That's mixing advertising and subscription, but because there's a land grab on for SVOD at the moment. So Viacom, Pluto TV, the social networks getting involved, QB with its short form, platform or device-driven platforms like Roku, and publishers who've come or skewed from more of a print background beginning to get it heavily involved in AVOD video as well. So we heard from the market from Tubi, who talked about their very rapid expansion. We heard from Rakuten, who are launching a new AVOD tier, and we also heard of a new kids AVOD service, also from Tubi, that will be launching imminently. So Tubi talked about its viewership now totaling 130 million hours across its catalogue, which now totals 5,000 titles. And that itself is creating an opportunity, because the deep catalogue that 5 years ago distributors could sell to Netflix and others can now be sold to AVOD. As the SVODs are refining their offer and shifting more to the premium end of the market, AVOD is providing a cash cow lifeline for deep catalogue and long tail content sitting otherwise unloved within distributors' catalogues. An overall final trend really is the role for distributors and the way that is changing and evolving. So if we think about the distribution model 10 years ago, maybe can validly say even 5 years ago, it was largely about handling the buyer relationship, taking content and taking it to the end buyer, who then took it to the consumer. Now, of course, distributors were getting involved in financing, deficit financing, making up the difference from a broadcaster commission for a new production. But increasingly that is not enough, and it's partly driven by the very high budget, by the very, very high volume demand for high-end content, that distributors have gone back one step in the chain to the commissioning, to the development, to the talent, to the script writing, to funding script development, to working more closely with funding bodies. And really, this is all about ensuring that the content that is now so demanding in terms of money is suitable and best positioned for sale into the international market, and to make up that increasingly large deficit. Because the other thing that was talked about quite widely among the people I spoke to was the fact that the broadcaster contribution hasn't changed. So while the budgets have got bigger and bigger and bigger every year, the broadcasters are paying about the same up front for a new commission, making the deficit an ever-growing monster. And for that reason, distributors are both seeking to grow their own scale, to invest themselves in production assets, but also to be more hands-on much earlier on in the production and distribution chain. And so those are my thoughts about the key takeaways and the key trends that emerged at the market. I'm happy now to see if there are any questions or anything you'd like to discuss. Okay, so we have one question here about Sony and the closure of View. So it's an interesting question. So we have two tiers of studio, really, or two levels of aggression in terms of approach to direct to consumer. Disney at the very top, a pure play content company now, combined with Fox, who is going all or nothing for a very aggressive direct consumer rollout. Then I guess we have tier 2, which would encompass Warner, NBC Universal, large studio catalogs, but who have parentage that is still embedded in a more traditional business. And they will be the second tier of aggression in terms of direct consumer launch plans. And then below that, we have the smaller studios who have to balance finely between their licensing business and indeed the growing opportunity of that licensing business as the very big studios go fully direct, and their own direct-to-consumer offers. So while they have closed or announced that they're closing View, I don't think it means that they're getting totally out of direct-to-consumer. Studios like Sony, like Paramount, will be looking to license where it makes sense and launch direct-to-consumer where it makes sense, where perhaps their licensing market is not quite as big and the opportunity not quite as great. So any other questions? If not, I'll hand it back to Karen.
Thanks, Guy. That was a great insight into this year's MIPCOM. Sure, it gave everybody something to think about for the rest of the day now. We don't have any more questions, but thank you all for taking the time to attend. If you have any questions, you can always email Guy. His email address is there, or you can send them to info@ctameurope.com. A recording will be uploaded onto the members-only section of the CTAM Europe website, and we'll follow up with a newsletter in the next week or so. If you have any further questions, let us know. And Guy, thank you once again. And I wish you all a great week.
Thank you.
Thank you.